Hello and welcome everyone to the monthly market update for May 2024. My name is Steve Latham and I'm the Chief Investment Officer for Bernanke Wealth Management. Tonight we're going to be discussing stagflation. Is it here and is it something that we need to worry about? Jerome Powell, the chairman of the Federal Reserve, recently said that he isn't worried about it. So let's look at what the data shows us and see if we can draw our own conclusions. So let's first start off with the inflation part of stagflation. And what we've seen to start the year, as far as the consumer price index is concerned, is that inflation has run a little hot compared to what our initial expectations were. Looking at the first chart on the left, we see two lines, the blue line, which is a rolling 3-month average, and then the orange line, which is a rolling 12-month average. And the 3-month average, which is going back since February, has shown quite the spike to start the year for inflation. But if we draw that back over the 12-month average, it barely is even registering on that line, suggesting that looking back over the last 12 months, inflation is still in somewhat of a downward trajectory. If we go to look at the expectations for inflation over the next 1 year and 3 to 5 years, which is the right-hand chart, we also see that there's a very modest tick up in inflation expectations, but nothing that we need to be terribly concerned about yet. So if inflation is still something that we should be concerned about, let's look at the components of inflation to see how that's really feeding into the headline number. Here's a couple busy charts, admittedly, so let's break it down for you here. On the left-hand side, what this is attempting to do is break down the subcomponents of the consumer price index, or what is really feeding into inflation over the last couple years. Going back to the beginning of May 2022, we see that it was a pretty broad array of components that was feeding into that really heavy inflation number. You had energy in green, you had core goods in orange, food at home delivery services in purple, eating out in light blue, and then shelter in that dark blue towards the bottom. And as we move towards 2023 and into 2024, we see that a lot of those components have fallen off, which is exactly why inflation has come down since 2022. But there's a couple of components that have really taken up a bulk of what inflation is accounting for now. Specifically, we see inflation related to shelter as the largest component and the stickiest thus far. We've had a hard time seeing that inflation number for shelter coming off of its peak. Additionally, auto insurance has actually increased as a core component of inflation during this period of time. And really between those two metrics, that is almost 70% of what the total consumer price index inflation figure shows. Taking a look at the chart to the right, we see that auto insurance is even a larger component whenever you exclude shelter as a measure of inflation. And auto insurance is one of those things that we've seen starting to come off as far as price increases are concerned. And looking out over the next 6 to 12 months, our expectation would be that it would come off of a core component of inflation, or at least feed into some of the disinflation. Meaning that if we're looking out throughout the rest of 2024, we really need to concern ourselves with shelter as an inflationary pressure and auto insurance as an inflationary pressure. And we see a lot of anecdotal evidence that both of those should be coming down throughout the course of the year. Okay, so we've gone over inflation. Let's take a look at the stag piece of stagflation. And what that means is a stagnant economy, meaning that inflation is increasing, but the economy is not growing. One of the best measures of economic growth is gross domestic product as measured by the GDP. And so we had our first quarter's GDP number hit the market here in just the last couple weeks, and it came in underwhelmingly low. It was at about 1.6% compared to expectations at 2.5%. That's one of the biggest reasons we've heard that stagflation moniker get thrown about in the media. But let's take a look at that in the broader context of history. So the chart on the left here shows us the GDP going back over the last almost 10 years. And we've seen a pretty steady trend throughout the teens. Obviously, here's COVID and then our bounce back from COVID. And now we've seen a slight deceleration since we've really normalized from COVID. And yes, that 1.6 number is a little lower than what our trend was in 2023. But let's stretch that out even further. Looking at real GDP going back to the beginning of the century in 2001, we see that the trend for GDP over that period of time is 2%. And throughout the teens, we were underperforming from a growth standpoint. We see COVID hit right around here. And then we've bounced back. And in fact, if you look at it again in a long-term picture, we're not too far off of trend right now, even though we had this 1 quarter's worth of lower than expected growth. So when you look at that and you take Jerome Powell's explanation into consideration for, is stagflation here? Well, he sees neither the stag nor the flation as a major concern. And so to parlay that and wrap this up into how this impacts total Fed cuts for the remainder of the year, well, we've seen the overall cut rate come down quite substantially. And what this chart shows us are the probabilities for where we think the Federal Reserve's overnight rate will be at the December meeting at the end of 2024. And if you look at each of these bars, the dark blue bar is where we currently believe rates will be at that point. And then as the bars get lighter, that's where they were expecting the rates to be over the last day, the last week, and the last month. And so currently we're at this 5.25 to 5.5% range. That's where we believe, or we know we are right now. And right now the market gives it about, let's call it a 10% chance that we will be at this 5.25 to 5.5% in the December meeting. A month ago, there was almost zero chance for this range to be there in the December meeting, meaning that the market was expecting the cuts to be quite substantially more. And in fact, the market odds for where we were going to be a month ago was down in the 4.5 to 4.75% range. Now it's basically a coin flip between the 4.75 to 5% range and the 5% to 5.25% range. So all this being said, inflation has spiked a little bit. We don't believe it's an emergency right now, and we don't believe Federal Reserve policy is going to be pivoting so much that they're going to be putting rate hikes back on the table. We think the two core components of inflation that are driving it right now, shelter and auto insurance, should moderate for the rest of the year. And even though we had a slightly slower growth rate for our economy for the first quarter, we do believe that will pick up modestly in the second quarter and throughout the remainder of the year. So our take is stagflation is not here yet. Of course, we're going to be keeping an eye on it going forward to see if there's anything that changes materially from these observations. But for the time being, we're comfortable with where we're at right now. If there's any other questions that you may have around stagflation or anything else related to the economy, please don't hesitate to reach out. Thank you very much.